Hello Proponomics people, and this is the 4 pillars of investment video from 6th of April 2024. So there's one of these every week, a quick overview of the 4 pillars as usual. So the 4 pillars are a strategic framework that I've come up with over the course of the past 8 years, used them and still use them every day in my own property group and in order to guide me in terms of the strategy and the tactical decisions that need to be made on the ground. And we're on to our second pillar, which is the financial pillar. Lots of people say you can do anything as long as you've got the deals and the money. The reason I came up with the framework is I felt that was a bit of an incomplete statement, because I think you need delivery, and I think you also need to be able to manage assets and keep your attention on them apart from anything else, and make good decisions over time. But the deals and the money are, without a doubt, the most important two. You can't do it without the deals and the money, realistically. So those are the first 2 pillars, and we're on to the second one, which is the financial pillar. Every pillar is split into 7 sub-pillars, 3 of which are more entry-level, more accessible strategies. You don't need too much behind you or too much in terms of formal or informal training, education, your own personal development to get involved in them. The other 4 sub-pillars are more complex, and I wouldn't recommend them to beginners. I think you need quite a bit of experience under your belt before you take on a lot of these more advanced ones. And the first one of those 4 advanced ones, I like to call My Money Tomorrow. So what do I mean when I say my money tomorrow? Well, what I'm talking about is ultimately being able to borrow from the future with a level of certainty. So there are a number of different ways in which you can do this, and a number of different ways in which I've done it. Let's look at a really simple example. Let's say you've got a really stable job or a stable income, a stable business, like something like a letting agency that produces pretty much the same amount of cash every month. And let's say that amount is £5,000. And let's say you need £50,000 in order to put down for a deposit on a property in your area, and you're not trying to do anything particularly incredibly clever. And of course, the point of the pillars is you can blend a lot of these things together, and it's putting them together and combining them that really gives you that growth and that power within your investment portfolio. But let's just look at this in isolation for the moment. So within 10 months, assuming you don't need to spend all of that cash anyway, you'd have £50,000. If you could borrow that £50,000 from somewhere, and you could service that £50,000 debt somehow with cash flow that you've got from an existing portfolio or cash flow from somewhere else, then you could use that £50,000 in the next deal today rather than waiting 10 months to do it. And that's the basics of the concept that I'm talking about. Where and how are you going to get that money? Well, you can look at all sorts of things. You're not going to borrow 50k on a personal loan, but perhaps you and your partner could do 25k each. That would be one way of doing it. Personal loans of up to 25k are widely accessible. If you've done what I've suggested in previous videos and make sure you curate your credit rating and make yourself financially attractive and all the rest of it. This is obviously not investment advice. This is a number of things, all these different things that I've personally done over the years. And the point is to give you options in terms of where to get money from. So one of the things I was screaming about in 2021 was saying, look, if you think you might be short of cash flow and you want to get a personal loan, now's the time to do it, because it was below 3% the rates on personal loans that you could pay back over the course of 7 years. Which also in itself brings up an interesting point, because although the interest rate was very low, even though 7 years is a long time, there's still a payment to be made every month. And quite a bit of that is capital repayment, which can't be expensed against future profits. So you do need to remember that when you use this strategy, you are bringing money forward from the future. In many ways, it's what the UK government and a lot of governments around the world do when they borrow. They're saying, don't worry, we've got a growing economy. We'll be able to pay you back in the future via economic growth. Whereas the reality looks more like we can pay you back because there's inflation on the debt, and when we do pay you back, it's not worth what you thought it was worth. But of course, they have these long interest-only terms, and that's why interest-only can be so powerful, fully expensable if you have got tax to consider, which the government haven't, but you don't have the fiscal drag of actually physically paying the money back. What happens when the capital comes up? Inevitably, they renew it and they repay in a Ponzi scheme style way with other people's money to pay back the initial money that they borrowed. That's the governmental way of doing things. But personal loans, one way of doing it. I have in the past been able to say, look, I've got free cash flow of X against these properties here, and perhaps I could therefore borrow Y and service that debt. How am I going to pay the capital back? Well, in, let's say, 5 years' time, I'm going to go through another refinancing cycle with the property that I'm acquiring. My projections are showing it's going to have gone up in value by Y%, and therefore that will be enough for me to be able to repay the capital back. Of course, if you're putting that money into something like a buy, refurb, refinance kind of deal, then ultimately you would hope that you're going to get that money back out on a much shorter time frame anyway. But if there's money left over, or if you want to put that money into another deal, and of course if it suits the person who's lending you money on a bond style basis. So I'm talking about potentially 5-6 year terms or even 10-year terms for some of this money. I'm not talking about project finance, which is what most people tend to use in this game. I find it a bit linear, to be honest with you, and this is why it's a more advanced strategy, because I have been and am always running multiple deals at once. The most projects we've ever had under Refurge is 43. So 43 individual bits of project finance would have been a nightmare to deal with. There wouldn't have been much point in doing it that way. Better off to have a longer term arrangement. I'm not saying we don't use project finance, because we do, but we use project and we also use longer term. So this is based on pretty much how a building society would run in terms of when people put money in for bonds. This is a comparable product to a bond for investors to consider. And like I say, as long as it suits the investors, it's got a fixed rate of interest. What does it do for the investors? It gives them a lot. So people who put money into bonds and savings accounts last year would have seen this. Interest rates were at a particular multi-generational high. That was great when people were shoveling money into own accounts that were paying them 6% interest. That was fabulous. The problem is when that money matures. If they did that for 12 months, when it comes out, it's not paying them 6% anymore. It's paying them 4.5 or 5 or something like that. And then what happens when it comes out in a year's time? It's probably paying less again, because interest rates are back on a decaying sort of cycle. So we do need to bear that in mind. So that's a little overview of what the idea of taking money from the future can look like. And you imagine you've got to stay on top of your cash flow if you're doing things like this, because you've got the interest payments to consider, but you've also got the capital repayments to consider. And you've also got to work out your own time horizon. So from my personal perspective, I know, health allowing and all the rest of it, I've got at least 10 more years in the ascendancy in this game. I still enjoy what I'm doing. I'm up to the challenge. If anything, I'm working harder than I've ever worked at this sort of stuff. I'm working harder at putting good people around me and all the rest of those things that I need. So I know I've got a 10-year horizon by which, at that point, I may well be looking to pay back that debt and then give those investors a big thank you, perhaps a little bit of something special on top, but also give them that reinvestment risk problem that they are otherwise facing on shorter terms and have been facing at lower interest rates than I've been able to offer them. Hope you enjoyed that and hope it makes sense. Thanks very much.